The rupee has slipped to a fresh record low against the US dollar, touching around 91.08 in just 1 month. The rupee has weakened 2.5%, and over the past 1 year, it's lost more than 7% already. So the big question, why is the rupee falling so sharply, and should we be worried? Let me break it down for you. US tariffs are one of the biggest reasons behind the rupee's fall, with trade tension with the US still not sorted. The US has imposed tariffs as high as 50% on select Indian exports, making Indian goods far less competitive in global markets. When exports slow down, dollar inflows into India reduce, and that directly weakens the currency. Reason 2. Heavy FII outflows. The second major reason is that foreign investors are pulling money out of Indian markets. Foreign institutional investors, or FIIs, have been net sellers, especially in equities. But why? Higher interest rates in the US, stronger dollar returns, global risk aversion, and disappointing earnings from the last few quarters from Indian companies. When FIIs sell Indian assets, they convert rupees into dollars, increasing dollar demand and pushing the rupee lower. There's still a third reason now as well for the slowing currency, and that is weakening FDI inflows. While portfolio money is leaving, foreign direct investment has also slowed down. FDI is long-term stable capital, and when those inflows moderate, the cushion for the rupee weakens. Add to that global slowdown worries and geopolitical uncertainty, and investors are becoming more cautious about committing long-term capital. Reason 4. Strong dollar and global factors. Globally, the US dollar remains strong vis-a-vis other currencies. The US economy is still resilient, and interest rates have stayed elevated and now are slowly starting to come down. India is not alone, but the impact is sharper due to trade and capital flow issues. What does a weak rupee mean for you? A falling rupee has real-life consequences. Imports become expensive, especially crude oil. And remember, we were saved as crude prices remained lower and stable at the moment. Electronics, fertilizers, everything becomes more expensive. Inflation risks increase. Companies with dollar loans face higher repayment costs. Overseas travel and education become costlier as well. On the flip side, exporters may benefit, but only if tariffs don't offset that advantage. What is the RBI doing on this? The RBI has actively been managing volatility, stepping in through the Forex market when needed. India still has comfortable Forex reserves, which gives the RBI room to prevent any panic moves, but it cannot fight global trends indefinitely. The RBI's goal is stability, not defending any specific level. So what should investors watch now? Going ahead, keep an eye on 3 triggers. 1. US-India trade negotiations and any easing of tariffs will help. FII flow direction in 2026. Will money return or continue to exit? 3. Dollar movement and US interest rates. These critical factors will decide whether the rupee stabilizes or remains under pressure. For now, volatility is here to stay. The real test will be how quickly policy clarity and global confidence returns.